There's plenty of fear and loathing on world markets today. Stock markets here and in Asia are plunging, and they've been taking their lead from Europe and the US, where the twin nightmares of possible continental default and a lack of confidence in America are really biting. We have the ABC's Alan Kohler and Martin Lakos from Macquarie Private Wealth standing by on what's shaping up as the worst trading day since the depths of the global financial crisis. Let's go to Martin Lakos first of all. So Martin, what are the reasons behind this latest meltdown?
Ros, good afternoon. Well, certainly there's been increased risks and perception that the European debt issue is going to escalate, really in regards to Italy, which has been brought into the picture now. Now, Italy's obviously got a much larger level of debt than Greece or Ireland for that matter, but it's also a much larger economy, so therefore potentially has the propensity of being able to work its way through. A couple of things worth noting: that the per capita, that is by each individual in Italy, has one of the largest levels of wealth in terms of hard assets, greater than nearly twice greater than the US, and certainly greater than that individuals in Germany. So potentially one way out is for the Italians to put a one-off wealth tax onto the Italians to basically raise some money to assist in their ability to pay off debt. At the end of the day, you've still got the European Union, who's clearly made moves already by setting up its mini IMF fund to support these sorts of issues. And we think that the EU will not allow Italy to go to a default position, but help work with them to service their debt levels.
All right, well, let's take a detailed look at the damage now. Here, the All Ords is down 200 points. In Japan, the Nikkei is giving up almost 340 points, and the dollar looks like it's on a piece of elastic off 3 cents from this time yesterday. And this was today's trigger. Wall Street lost over 500 points this morning. That's its worst one-day fall for 2 years. The FTSE in London shed nearly 3.5%, and oil is also a casualty, down over 6% in 24 hours. So closer to home, Martin Lakos, which sectors are feeling the most pain here on our markets?
Yeah, well, Ros, typically in these volatile sell-offs, it's pretty much broad brush, but the defensive sectors are doing relatively better. So the likes of Coca-Cola, for example, and Telstra. But there's no doubt that those companies or stocks that have got leverage to global growth are being hit pretty hard. So we're talking about materials stocks and energy stocks. And that's despite the fact, for example, that Rio came out with a very strong result yesterday, $7.8 billion for the half, and increasing its share buyback. At this point in time, Ros, markets or investors or traders not really wanting to take a step back and look at fundamentals. They clearly are looking at the risks, and we're seeing that across other assets as well. So hence sell-offs in currencies, sell-offs in other commodities as well.
And how do today's falls here compare with what happened in 2008 when the GFC hit?
Look, this is without a doubt, it's a large fall, but we also have to put in perspective that the market's already fallen from 4,900 on the ASX 200 since late April. So the market has taken into a lot of account and discounted what's been going on through the Japanese tsunami, right through the sovereign debt issues in Europe and the slowing of growth in the US. So a lot of bad news is factored in, but there's absolutely no doubt there's a perception there that risks are increasing.
Martin Lakos, thank you.
Thanks, Rose.